Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and if you remember from our last video, we looked at the pros and cons of startup investing. Against those high potential returns were a lot of risks, and the fact that half of those startup investments in a study of angel investors participating in those private placements returned less than the original investment or nothing at all. This is an investment you need to know how to analyze, how to dig into the financials and find the best investments for your money. In this video, I'll show you the same process I used as a venture capital analyst to value startup investments. We'll look at how to do a quick analysis of the startup deals along with the warning signs to look for in each investment. I'll also show you how to look at the financial statements to find those investments with the most potential and then how to value these high return deals. The video is in partnership with equity crowdfunding platform Republic, a platform that connects investors to those startup investment opportunities. Anyone can invest on Republic and you can get started for as little as $100 in some of these deals. What I like about Republic is its VC-like approach to the due diligence and the analysis. And the platform has a team of analysts looking over potential deals, looking at that prior financing, the business model, management, and the market. Now, this isn't going to be the same level as a venture capital analyst, so you still need to do your own diligence, but Republic has one of the lowest acceptance rates for projects compared with similar securities crowdfunding platforms. Around just 1% of the submitted deals are approved to be listed for the crowd to invest. That due diligence by Republic is important, and I'll leave a link to Republic in the video description below, but it doesn't mean that you're off the hook on your own analysis. In that angel investing study that we looked at in the last video, the median time spent analyzing any given deal was around 20 hours. Now, spending more time on due diligence isn't necessarily a guarantee for those higher returns, but being educated about a company that you're investing in is always going to be a plus. By doing your own due diligence, analyzing the investment, you can get a better sense of what the market opportunity is and where the company is going. So I want to get started, but if you haven't watched that first video in the series, make sure you check that one out. It goes into detail on startup investing, equity crowdfunding, and why every investor needs these in their portfolio. So I'll leave a link to that first video in the description below as well. Make sure you check that out. Now, you're going to hear me use the term due diligence and analysis pretty much interchangeably throughout the video. Due diligence is that process of analysis that you use to weed out those bad investments and find the best deals for your money. Because of that high failure rate on small businesses and startup investments, it's absolutely critical to use some kind of a due diligence process. And one of the first steps in this startup analysis is just looking at the company's management team. I know angel investors that look almost exclusively at management, and that's how important this is because I don't care if you have the best product in the world or a hot market. If the company's founders and their team aren't ready to take that company to the next level, it just isn't going to happen. Management and the founders of the company have got to be hungry. They can't be satisfied just with good growth. They have to want to dominate that market and be willing to sacrifice everything else to do it. Now, this one is a little more abstract than the other points that we'll look at, so you really want to look at the company on 4 factors here. First is what level of experience does management have in that industry? Nation, this is huge in a world of easy startups and serial entrepreneurs. You get so many people out there that have never really worked in an industry. Maybe they have some tech experience and can create an app, but they've got no real world experience in that industry in which the app is competing. So for example here, if you have someone to maybe create an app for food delivery, which is hot right now, but had never worked in food industry, maybe in quick service or in delivery, then you got to wonder if they really know enough to create that app that serves customer needs. So if not the founders, I at least want to see some deep experience in that industry on the management team. I want to see that they've worked in different roles in the industry all the way from the ground up and have experience in managing those roles. Now, as an investor, I also want to see some experience in finance for someone on the management team. Maybe this is just my bias as a finance guy, but I want to know that someone on the team knows the numbers. Having that great idea and the passion is one thing, but you better be able to understand how the financial side works out and be able to plan through it. Next here, I'm going to be taking a close look at management's market share assumptions. I love this one because if nothing else, you can always get a good laugh when you find some of those bad investments. And you get these entrepreneurs that think their company is just the best thing since sliced bread and is going to come into that market and just blow it on its head. And I love the passion and the excitement, but if your assumptions for how much of those sales that you're going to take from competitors isn't realistic, it's going to be a hard pass for me. So here you're looking for management's assumption on the market size. How much in sales is that product is booked for all the companies in it. Then you're looking at what level of sales that management thinks it can make over the next few years. What revenue is it projecting? Because realistically, most startups aren't going to be able to come into an established market and take more than about 10% of sales. So be wary of any management assuming that they can dominate the market immediately. Finally, on the management side here, I want to see that the team has thought through the competition. First, for this one, has management even researched the competition? The biggest red flag for some of these kinds of deals is just a team that says there's no competition for our product. And that's the point where I usually walk out of the presentation. But besides that basic competitive research, I also want to see that management has thought through what competitors are going to do if this new company enters the market in a big way. Where they start a price war, and how will management respond to that? Are competitors likely to raise legal challenges or spending more on marketing to retake that market share? All of these questions management has to be able to ask and answer before they're going to get my investment dollars. The warning signs here, of course, would be just a total lack of some of these areas. So if nobody on the management team has any industry or financial experience, or if management thought it was going to come in and just jump into this market, taking a huge market share and never get any pushback from competitors. Now, after doing this analysis on the management team, I'm going to move to the financials and the projections for the company. All startup investing deals are going to provide some level of financial reporting through that Form C filed with the Securities and Exchange Commission and then linked on the Republic platform. Clicking through to the form, you're going to see a balance sheet and an income statement at least for the last 2 years. Reading through this form, you should be able to find some of the assumptions that we talked about, like market share and the competition. If management doesn't explicitly forecast sales or earnings into the future, these can be used to make your own estimates for sales over the next 2 or 3 years. Now, what I'm looking for in these financials is, again, those assumptions that management is using going forward and the comparison with the companies already in the market. You see, most deals are going to have publicly traded companies already in the market, so companies with public stock and reported financials going years back. You can go to the investor relations page for these on their competitors, download their financial statements, and use that as a sort of sanity check for these startup deals. So publicly traded companies, those where you can buy stock on your investing platform, they have legal requirements to report these financials. Any investor can visit that investor relations page, download those financial statements, and then use them as a metric to compare those startups in similar industries. That means you're looking for the same assumptions by management at these established companies in that same industry. How fast do they expect the market to grow? Can you find any commentary or growth on the costs and product prices? You can also compare what some of the startup management is saying against the reality of what you're hearing from competitors. Some warning signs here would be that if management isn't giving any kind of projections or forecasts for future sales or earnings, they aren't even making an effort to estimate those numbers for you. Another warning sign would be if assumptions on the growth or the costs are way out of line with what you see in all the competitor reports for the market. Now, the way you value these startup investments is by comparison with those publicly traded companies. So as an example, here's the analysis I did on Pinterest years ago before it had its IPO, when it was still a private company raising money from angels and venture capital firms. You can see I started by finding all the similar companies with public stock, so those in the social media space. Then I found the price multiple on those shares for price to sales and price to monthly active users, which is one of those most important measures for social media companies. Now, looking at how much investors were willing to pay for these sales and each MAU on these other sites, I could use those sales projections and the user estimates from Pinterest management from the Pinterest deal to find a fair value for the company. So you can use this valuation along with your analysis on management and its financials, use this all together to get an idea of whether you should invest in the startup or not. So is the company's valuation at which it's raising money high compared to your own analysis? Do you see some of these warning signs in the management or the financials? Asking yourself these questions doesn't guarantee a good investment, but it does raise the odds significantly that you're going to be investing in the best new companies out there. Nation, I know it's a lot of work. This is what I did full-time as a venture capital analyst, and it can seem overwhelming, but this is how you find those investments with the potential for 5 and 10 times your money. So I'll be using 2 startup investment deals on Republic in our next video to show you that step-by-step on and how to apply this process. So make sure to look for the link to Republic in the video description below. Click on the video to the right for our first in the series on why every investor needs startup investing. I'll share the ins and the outs of this high return investment strategy and how it fits with your portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.